Welcome to IDC Financial Insights Worldwide Financial Services 2012 predictions entitled Thriving or Just Surviving. Our top 10 predictions are put together with the help and input of IDC's Financial Insights analyst team globally. And as in prior years, we have our top 10 predictions, and then underneath each we break out by major region with additional sub-predictions or input to help give color to the regions. As with our previous predictions, the goal is to identify trends that impact financial institutions from both a business and technology decision. The process is drawn from insights in IDC studies, industry contacts, and our own industry experience, as well as working with our analysts across the globe. The time frame for our predictions is 2012, but obviously many of these will have a longer range impact, and all 10 predictions are interdependent and listed not in order of importance. Looking at our 4 key financial services themes for 2012, many people will find that these are very similar to 2011. The first is around global institutions looking to be more effective in managing regulatory and their compliance burden. The second really provides around a seamless cross-channel experience, which is an important component for customer retention. The third is the continuous march towards efficiency by focusing on technologies and processes that help reduce costs, which is really becoming more standard operating procedure. And the last theme is around revenue enhancement, both from new product development, innovation, and increased fees that will be needed to offset declines in non-interest income. In addition to our key financial services themes, we also see some key financial service initiatives and influencers in 2012. The first is on capital optimization, where we'll be looking at projects and new initiatives that will continue to look for the best use of capital for the enterprise. The next is on channel enhancement and look in order to find a more consistent customer experience across all channels, including a strong move to mobile. The next is on infrastructure improvements, and we'll be talking about legacy infrastructure in a bit, but that's both a risk and an operational issue for many financial institutions, and so improvements will need to be made across the board. And finally, we'll have the market impact on both the economy and IT spend. As we've seen with both the debt issues and euro issues across the globe, the performance of key markets and economies will continue to impact the level of IT spend.
Our first prediction is that tumultuous financial markets, failing institutions, and lower profits in Europe and the United States will inhibit but not eliminate IT spending growth. Worldwide IT spend by financial institutions will reach $394 billion in 2012, which is a 4% increase over 2011. But it's really a tale of many markets with important differences across the regions and types of institutions. In the hardest hit markets, the institutions are increasing their use of offshoring to really drive down costs, while in emerging markets, the growth in consumer credit as well as general expansion plans are spurring growth and technology investment. So within the regions, Asia Pacific, even with the tsunami and the rebuilding in Japan, the region's going to see IT budgets grow by 7% on average. The investments will shift away from whole of core banking investments to more selective upgrades of key core banking modules. This new approach really to core banking modernization will really drive an uptick in spending in certain markets in the region, but it'll be phased out over several years. These core banking projects are going to have significant follow-on spending for channels, business process management, and product management systems. So that'll really help bolster that region. In Europe, IT spend will increase by a real paltry 2.9%. Banks will see margins erode as they continue to face competition from new competitors and taking advantage of new technology to get into that market. The Eurozone current large IT projects are risk being canceled as they continue with the fallout from exposure to the southern European economies, and IT reliability is increasingly under scrutiny as banks struggle to increase profits yet shore up aging legacy systems. And this is a trend we're seeing in all the regions, quite honestly. In Latin America, we're actually going to see the largest percentage increase, where spending will increase by over 10%. They're really benefiting in Latin America from a strong economic growth and really this increased consumer use of the financial system. Banks there are investing in core solutions, channels, and the consumer credit solutions to grow their business and meet the customer's needs more efficiently. And finally, in North America, here in the United States, institutions continue to reel from the contraction of the U.S. economy and increased regulatory pressure. In the U.S. market, we're seeing IT spending growth at a real modest 2.4%. Banks are going to continue to contract in the number. They will also contract in footprint as they close branches to match costs to revenue. Our second prediction is focused on the customer experience. We feel that in 2012, financial institutions will continue to struggle to find the right channel mix for an optimum customer experience. The trend towards self-service varies from region to region. In emerging markets without the legacy of a branch network, the alternative delivery channels are often the only channels, particularly for rural areas. That said, the challenge continues to be on delivering the correct mix of channels to create a consistent and satisfying customer experience. Patchwork channel solutions are often the result of financial institutions looking for best-of-breed solutions for each delivery channel or to fill an immediate need not offered by legacy providers. Mobile is a good example of financial institutions perhaps rushing into a solution with little time for strategic planning. Financial institutions will need to look at all channels, including branch, to utilize the best that today's technology has to offer while providing the best experience for their customers. This will translate to branches transitioning even further from transactional centers to sales centers. Next-generation online banking, ATM, and mobile solutions will also be deployed, focusing on a convergence of channel and technology. This will provide more involvement from both line of business and marketing, as well as IT in making key customer-facing technology decisions. Delivering the correct product at the optimized price on the preferred channel for each customer should be the goal of all financial institutions. Evolve to where your customers are, primarily using non-traditional channels to get the word out. In each region, in Asia Pacific, transactional self-service will increasingly be the way through which retail and insurance and banking customers will interact with their institutions. IDC Financial Insights predicts that 3 out of 5 customers in 2012, excluding the unbanked, will bypass the frontline staff at the branch or insurance agent in favor of either the online, mobile, or call center channel. Now, the huge underbanked markets in Asia will continue to use the branch network and see expansion, although lessons from more mature markets elsewhere will force them to go to a smaller footprint and a better designed branch. In more mature markets like Australia and Singapore, several leading institutions will come up with next-generation bank strategies. Europe and the Middle East saw a flurry of social media and mobile conduits launched to better service the customer in 2011. However, many banks are replicating the errors of the past as new channel infrastructure is often siloed and hasn't effectively been integrated into existing analytics and customer information systems. Few banks use these channels effectively, taking advantage of features such as crowdsourcing and geolocation. In most European countries, banks with narrow channel strategies tend to have a better customer satisfaction level. As investment budgets come under scrutiny, banks will need to have a better vision for the way they service their customers, leverage existing software solutions, and ensure that they leverage a full breadth of functions that will add value to their offering. Latin America, mobile continues to drive much of the expansion here, particularly in Brazil. However, mobile functionalities are expected to remain basic as standards such as mobile payments are still under discussion. More traditional markets will continue to struggle with finding that mix of online and traditional offerings. Social media remains fundamentally important as how presence and channel penetration are regarded, although most banks haven't really developed a solid strategy and positioning to benefit from the web interaction yet. And finally, in North America, a resurgence in the ATM will really begin the transformation process at the branch level, allowing for more personalized, high-tech transactions possible through a channel most people are comfortable with using. IDC Financial Insights predicts that growth in the demand for decision management support platforms across all industries will double from last year's forecast, and that's driven by the enterprise management needs. Financial services will see an increase in platforms that allow them to find the right mix, product, price, and channel for their customers' needs. U.S. firms will continue to look at social networking as a marketing tool to increase web traffic and not necessarily as a channel.
Our third prediction is that financial institutions will see the need to develop a new business model, but execution will elude the industry. The backdrop to this prediction is that when we look at doing business in this post-crisis world, we are facing significant changes in demographics and technology. But more importantly, formerly reliable sources of revenue are no longer viable. For example, in U.S. banking, we've seen fee income from debit cards, overdraft, and the like slashed, and a continual shrinking of net interest income. Financial institutions should be thinking strategically and longer term of how to redefine their business model and identify new sources of revenue and cost containment. But instead, in 2012, we'll implement relatively minor changes within existing business silos to manage short-term profitability expectations. Unfortunately, what we'll see is continued erosion of profitability under these existing business models. In Asia Pacific, current sources of bank fees are being either eliminated, capped, or put under question, particularly in markets such as Australia and Thailand and the Philippines. This loss of fee revenue appears to be the major driver for banks in the region to create new business models. The ideas vary, and they depend on the maturity of the institution, and include debt recovery services, advisory and consulting, and even cloud computing provisioning. In AP, we also expect further disintermediation in the consumer payments value chain, because increasingly banks have to stay relevant in low-value payments, especially as non-banks are quickly redefining business and revenue models in this space. In EMEA, we will see bank IT departments use greater use of open-source software and toolkits in the quest to develop and launch new services faster. The goal is greater differentiation and personalization as part of delivering both an improved end-user experience and operational efficiencies. The challenge will be turning this into recurring revenue, as monetizing services while attracting users is a balancing act. Now, skipping to North America, the largest U.S. banks have been responding to regulators capping their revenue opportunities by punishing the retail customers with additional fees. Well, this strategy has backfired and U.S. banks have changed course. The U.S. banks have not yet taken a strategic approach to finding new sources of revenue. We predict that U.S. banks will lag behind their global peers in 2012 in determining what the optimal alternative revenue model will be. Also in North America, we are seeing enhanced liquidity solutions providing new revenue sources. As credit markets begin to thaw, expect to see corporate CFOs increase their demand for treasury solutions, and also for banks to explore new liquidity-based product options for retail customers. The story is different in Latin America. They have experienced relative stability in recent years, and therefore there is little reason for dramatic changes in the business models. Expect to see new initiatives that are focused on extending credit solutions to lower-income clients, as well as increasing the bankable population and increasing utilization of financial products available.
The impact on financial institutions of the economic climate in which they are operating. Banking, insurance, cap markets, each of these sectors will experience this impact in similar and dissimilar ways. With the impact of the economic crisis on the FI's ability to make money, we're predicting that next year we'll see the transformation of financial institutions and their approach to their businesses. The banks are faced with unique challenges. While still recovering from the impact of the economic crisis on their bottom lines, some of them are holding funds that are available once the appetite for lending improves. Provided care is taken to consider the limitations on spending these funds that are presented by regulatory capital requirements, this presents opportunities for new approaches to be taken towards revenue generation. Insurance companies are uniquely impacted by the economic circumstances in which we find ourselves, given their heavy reliance upon investment for revenue. With the poor investment climate in which we find ourselves, they are under pressure to find innovative approaches to generating revenue for their shareholders. The cap markets are challenged by investors' reluctance to invest given our, once again, current economic uncertainties. This leads to an increased pressure on them to discover new markets or new approaches for which to generate revenue. In Asia Pacific, we predict global players will rely more and more on Asia Pacific for revenues. The so-called China strategy will become a necessity in trade services, and mobile will be a key driver in new opportunities in the region. For EMEA, we believe this focus will be twofold. Delivery on new products, service standards, and marketing that has been strategized over the previous year will start to get implemented in 2012, and concerted efforts to develop ways to raise revenue through the development of risk-adjusted views of profitability will become more standard. Within Latin America, our two predictions are that the main strategy of large institutions has been the increase of new accounts, motivated by new credit offering and a larger branch network, and opportunities will exist for banks to expand into this market, either foreign or locally owned. For North America, increased spending will be driven by the suite of applications that support risk and regulatory compliance. North American banks are going to continue to struggle with the revenue generation and will invest in channels like mobile to maintain customer loyalty and competitive positioning. And insurance companies will use the technology for innovative solutions like pay-as-you-drive or usage-based billing auto policies. In summary, we see an increased focus on global financial institutions exploring new regions such as Asia Pacific and Latin America, the delivery of new products that had previously been strategized now being implemented, and increased spending to support risk and regulatory compliance.
Our fifth prediction is around IT reliability, which will become a major risk factor due to the age and complexity of key systems. Back-end systems are beginning to show their wear and their age as data processing increases along with the number of new requirements that are needed in financial services, including new products, new channels, new risk management reporting, etc. So we think this will really be an issue in 2012, and more than just the hardware, there's also an issue around IT knowledge base, where that's headed, where that's located, and the retirement age for many of the people who support these legacy systems. So if we look across the globe, starting in Asia Pacific, mature markets there will see a rash of severity 1 operational outages. Both human error and underinvestment in IT will be contributing factors there. And then additionally, business and process owners will be empowered and held accountable for the performance of IT as it moves just beyond the IT groups themselves. In EMEA, failures in Europe have been linked to system upgrades and migrations that reveal the complexity of working around these aging systems. And more stress from real-time data of new channels like mobile and social is taxing already fragile networks. In Latin America, IT reliability varies significantly across banks and institutions, but several technology refresh and improvements undertaken in the last year have been successful at reducing downtime risks. And finally, in North America, the lack of resources with the appropriate technology skill sets is becoming a major risk in supporting these legacy systems. So as institutions trying to reduce costs and meet regulatory guidelines by speeding IT projects to market, they'll cut corners with testing, and that'll create additional risks as outages will continue to increase. Payments. Most of the $90 billion in mobile payments value in 2012 will be generated by non-banks, primarily mobile network operators or mobile content platform. This is a result of lack of coordination between financial institutions with regard to technology standards, as well as a general lack of common mobile payment assets. As we look across the globe, Asia-Pac will lead the world in bank-operated mobile payment systems. And regulation will make mobile payments the domain of banks and bank-owned mobile ecosystems there. In addition, in Asia-Pac, the growth of Apple products will lead to greater convergence with global mobile trends. In EMEA, M-Pesa, an African mobile payment service offered through mobile network operations, will be a leading service in terms of volume, while in Europe, banks will look to add more transaction capability to their mobile offerings. In Latin America, new regulations for mobile payments will be in place, which govern both banks and carriers and will help to create a stable environment for rapid growth in 2012. While finally in North America, Apple iTunes service will be the largest generator of mobile payments, followed by PayPal, which leads in person-to-person payments. Also, in North America, 2012 will be a year of shifting alliances and competing press releases as various mobile wallet platforms like Google, Visa, ISIS, and other parties attempt to claim the leadership position.
Financial institutions will continue to tackle operational efficiencies and will target average cost-income ratios of 40%. So in the wake of continued economic instability, financial institutions are going to look at alternative delivery models for IT investment. Even the most customer-centric institutions are going to increase the use of outsourcing and offshoring as they drive cost out of the non-competitive technology and operational areas. Offshore providers will again see double-digit growth rates from just the financial services industry, and there'll be even greater declines in internal IT and operational staff spend. Private infrastructure clouds will move from pilot to full-scale adoption. However, in the pursuit of this improved cost-income ratio, institutions will need to be careful not to cut too deeply or too quickly where IT infrastructure is concerned without first gaining a detailed understanding of the risks involved and the potential downstream operational impacts. And that really ties in with the other themes of making sure that the IT infrastructure doesn't doesn't suffer. Specifically within Asia Pacific, outsourcing and offshoring will continue as key strategies for Asia Pacific banks to deliver cost efficiencies, but some of the early wins will be in better optimizing IT assets and better management. And just when there were signs the industry was really starting to buy into the business case for cloud, particularly for private cloud, some high-profile incidences of service failures and operational outages involving third-party has really proved damaging to the confidence of this innovative delivery channel. And we'll have to see what the long-term effects of that, but short-term it may mean a pullback. In EMEA, many institutions have already rolled out private cloud infrastructures, and institutions are looking for greater guidance for hybrid or public cloud usage. However, that comfort factor remains, and consequently banks are really hesitant about placing certain applications and technology into the cloud. So we'll kind of have to wait and see, as many banks are doing, as to what the next step will be. In Latin America, financial institutions are far from adopting cloud. Public cloud solutions are not even considered, mostly because of their concerns about safety. Private cloud solutions there have been discussed, but would only be adopted for non-critical applications such as email. And in North America, financial service sectors will increase the use of cloud services for some key global risk management activities, maybe credit scoring, identity management, cybersecurity protection, etc. And we expect that operational improvements for investment management firms, brokers, advisors, and third party will be a top priority as those types of solutions moved out to a cloud would make sense and would help reduce your overall operational expenses.
Our eighth prediction summarizes what we're saying this year about risk management activities across the financial sectors, and specifically about risk technology and services spending as we get closer to 2012. So a few overarching comments and then a few specifics about what our community of risk analysts are seeing regionally. Last year, if you recall, we did have a prediction about risk management investments, how we saw the hardware, software, services, and infrastructure supporting the risk discipline becoming a larger percentage of total IT spending across the banking, capital markets, and insurance sectors. This year, we've published the numbers in a forecast based on a revised taxonomy, which now includes 7 primary risk spending submarkets. And we're forecasting worldwide technology spending in support of risk functions at over $60 billion in 2012, and the spend growing collectively at a combined annual growth rate of about 7%. We expect the largest increases in risk technology spending to be in the areas of liquidity and asset liability management solutions, financial crimes management, credit, market and trading risk, enterprise risk management, and security. Now, there are certain downside risks that could affect these numbers, of course, and we're already seeing downside pressures in these numbers, particularly in the banking markets in the U.S. and in European regions, which will most likely be reflected in the next release of our forecast. One of the most important trends, though, that we're watching right now is related to the improvement cycle in risk management that many firms find themselves on today, and whether or not these improvements will actually take hold and become institutionalized. So regionally, first in the AP market, investments in risk management and compliance will be strong, representing a second round of spending on critical systems and process standardization activities to cope with an uneven economic climate. Additionally, effective project management and IT governance will be critical in the region and a critical discipline moving forward as institutions more clearly understand that IT governance is crucial and intimately entwined with the reputation and performance of the entire institution. In Europe, constraints on capital and capital reserves continue to dominate discussions for banks across the major European markets as they prepare for a possible change in the landscape of the Eurozone. At the same time, in the emerging markets in Eastern Europe, the Middle East, and Africa, institutions in this region are increasingly demanding greater understanding of the cost of capital and visibility into the effectiveness of their capital allocation. To this end, the risk function will become more integrated to the business forecasting process, necessitating a further integration of finance, risk, and business performance data, analytics, and reporting. In the North American region, the U.S. will see growth in risk spending in a few specific areas. Decision support platforms, as these are the tools for managing customer and product credit risk and determining the right mix of product, price, channel, and customer appetite. Also, financial reform legislation and regulations of derivatives, of the derivatives market, will continue to fuel large projects and investments in market and trading risk infrastructure, data quality improvements, and standardization. Also, firms will push for needed improvements in customer screening and transaction analytics for AML, payments fraud, and employee misconduct management. More risk services, we feel, are going to move to the cloud services model, and business executives will continue to refine use cases for big data and high-velocity capture, discovery, and analytical applications. Fraud and security management, trade analytics will be established as target applications for the new big data technology stack. Several of these risk spending trends will also be seen in Canada, particularly around decision support platforms, as the big five Canadian banks, with a conservative culture around risk in general, will be challenged in finding new ways to grow the business. Last but not least, in the Latin American region, Basel III will drive investments for capital management and treasury systems. More mature institutions, for example in Brazil, who have already made investments in the recent past, will likely spend moderately on remaining areas, including compliance and reporting. One last comment, information security or cybersecurity as a component of critical infrastructure will continue to be in focus as cloud, mobile, and social networks become a growing part of the financial services supply chain globally.
This is prediction number 9. Financial institutions will use social media to improve decision making and drive financial results. So globally, we see a lot of firms sitting on the sidelines or using social sites as a way to simply garnish more web traffic. However, leaders are being more strategic about their investment in social media. I think everyone understands the volume of social media users is impressive, and the argument for a firm not to be embracing it really diminishes their overall strategic effort. You can make the observation that 15 years ago, bank executives used to ask, why should they be using email or internet? Nevertheless, that said, it's certain that not all industries share the regulatory and data security privacy issues that financials do. So they are unique considerations that financial firms need to think through and determine how they participate in social media. With that in mind, what we see is most of the large banks doing monitoring. This is, from a technology standpoint, something easy and helps them understand where your company lies within the social media context. Internal collaboration is another area. Other approaches that we see to date are in philanthropy, servicing, recruiting, financial education, corporate communications, product placement, and branding as well. And beyond these, though, firms and their users want to bring more external social data internally and share it amongst their peer group. So smarter firms are turning their social media into social business opportunities, and that's defined as social business is defined as organizations that apply emerging technologies like Web 2.0, accompanied by organizational, cultural, and process changes to improve business performance in an increasingly connected global economic environment. And these firms are becoming more organized and focused on their social media strategies, and we're seeing this happen at an extremely rapid pace. Now, part of being smarter is attempting to also prove an ROI, and that's become more important, and it's really a mix of art and science. You might say, what is the ROI of the telephone? Nevertheless, it can be difficult for firms to justify the social media expense. It's hard to tie technology investments back to revenue. So one way we look at this is to measure an activity from start to finish and measure some result or output from that activity. Socialytics is helping not only to analyze social data, but also aid in that ROI demonstration. And the socialytics is defined as a set of cross-discipline solutions that are used to analyze social data created through socially based interactions. Now, given the work to date, one of the early benefits that we've seen globally from firms using social media are the time savings. So we've seen productivity increases of upwards of 11 to 30% as employees and their clients are really better able to communicate and do so more effectively and efficiently. Social media is, however, providing this platform to do much more than just efficient communications. And with the socialytics rapidly developing, we really anticipate that more crisp business models and value scenarios will emerge over the next 6 to 12 months. Beyond that, though, the big developments that we anticipate changing social media over the coming year will come from video, personal data preferences, how the clients and the end users determine the worth of their personal data, and portability requirements. So the questions we're really hearing from financial firms and the things they're working through, which vendors can help with, are understanding how committed and how fast your firm wants to be involved. What's the monetary value from social media? How are firms filtering out the noise from the social activity? Keeping in mind that positive messages are great, but negative ones can also be invaluable. So figuring out what the value is and how to use it is still a learning process. How do you leverage the SharePoints and the knowledge management systems and plug them into social? There's working on establishing a social channel communications governance framework. And also, cutting through all the information sources and these social channels can be tedious. So understanding how to connect via the right one and at the right time with your clients is a large learning process. And with that, we'll move to Tam.
Our last prediction is about the take-up of big data applications in the Tier 1 financial sector. In 2011, we're expected to reach 1.8 zettabytes of digital information worldwide, and that figure will double every year. Data is being generated by all kinds of devices, old and new, such as PCs, smartphones, intelligent devices, tags, sensors, etc., and also on the internet via social media. The efficient handling of this explosion of digital data is in the core of what we call big data. It is also a set of new technologies designed to solve complex information problems economically. Together, these technologies collect, manage, mine, and analyze large volumes of streams of varied information from multiple sources. The business imperatives outlined for these technologies include improved competitive edge and better agility by understanding customers, products, risk, and marketplace trends. Big data continues to present major industry opportunities. Over 40% of all Tier 1 banking and capital market firms gear up to execute big data and analytics business and technology strategies. Using big data technologies, banks and investment firms lead all industry verticals in business and technical implementations. Initial use cases focus on enhancing market intelligence and customer targeting and pricing, enabling real-time risk management and improving trade and portfolio analytics. In Asia Pacific, use cases for big data technology investments are centered on enabling single customer views, incorporating real-time information feeds, and integrating social media impressions. Big data will be the primary driver for data management initiatives in Australia and core banking innovation in other parts of the region. Other first and early applications for big data technologies in emerging markets will be to better manage payment card fraud, offering banks the ability to achieve higher benchmarks for accuracy and reliability in transactions processing. Big data technologies will also be used to enhance insurance claim fraud management and personal credit approval. In EMEA, particularly the European region, which has some of the most stringent data privacy regulation, financial institutions begin to tackle data protection and security challenges presented by big data technologies through the expanded use of encryption, data loss prevention, and access management technologies. In Latin America, although probably famous as heavy investors in IT, banks in the region have not been known for being early adopters. 2012, though, we see a strong turn towards big data solutions as most banks have recently revamped their basic infrastructure, including significant data center investments, and are looking at complex business analytics solutions to take place. In North America, CIOs, CTOs, and business IT executives increase their pressure on technology providers to demonstrate top and bottom line value for their investments as they begin to execute big data technology strategies. Business executives in the region continue to refine use cases for high-velocity capture, discovery, and analytical applications at leading financial firms and service providers. Market intelligence, fraud and security management, and trade analytics become established as the target application for the big data technology stack.
Thank you for listening to the IDC Financial Insights Top 10 Predictions for 2012. Except as otherwise noted, the information enclosed in this webcast is a property of IDC Financial Insights and is copyrighted 2011. Reproduction is forbidden unless authorized. Contact permissions at idc.com for information. All rights reserved.